Okay, take a breath, a real one. Inhale, exhale. Because if you have dared to look at your portfolio today, Friday, February 6th, 2026, you are probably feeling a distinct knot in your stomach.
Oh, yeah.
If you haven't looked yet, honestly, maybe don't. Go for a walk instead.
It is vivid out there.
Yeah.
I think sea of red is the polite term everyone uses, but this morning feels a bit more like a crime scene.
It really does. We are looking at Bitcoin plunging below $66,000, that post-election rally we were all celebrating a few months ago.
Gone.
Gone, erased. The headlines are dusting off that old favorite phrase, crypto winter. We're talking about $2 trillion in value wiped out year to date.
Yeah.
It feels apocalyptic.
It feels that way if you're glued to the price ticker, sure. I mean, panic is a very loud emotion.
Yeah.
But the mission of this deep dive is to turn down the volume on that panic. Because while the price action looks like a disaster, the actual flow of money, where the heavy capital is moving behind the scenes, is telling a story that is much more nuanced and honestly a lot more interesting.
So we aren't just going to stare at the red candles and mourn our losses.
Yeah.
Because I brought tissues.
Keep the tissues, but no, we need to dissect why this is happening. We're going to unpack the triggers, specifically the mining economics that are, crushing the network right now. We have to talk about the $40 million hack that just hit Solana.
Right. That's just adding fuel to the fire.
It is. But then we get to the plot twist, this smart money anomaly.
Fine.
While retail investors are panic selling, BlackRock is doing something that should make everyone, pause. Plus, we have to look at the quiet boom happening in AI and Ethereum.
So let's wade into the carnage first. Get the bad news out of the way. Bitcoin is trading in that $64,000 to $66,000 range. That's an 11 to 13% drop in 24 hours.
Which is a massive move for an asset with this much market cap. I mean, Bitcoin isn't a penny stock anymore.
No.
Moving it that much takes a lot of selling pressure. And when you move that fast, you break things. We saw over $2.65 billion in leveraged positions liquidated in a single day.
$2.65 billion. And for those listening who might not trade on leverage, we use that term liquidation a lot, but let's define it. Basically, these are people betting with borrowed money that the price would go up, right?
Exactly. They're long on Bitcoin. They put down a little bit of their own money and borrow a lot from the exchange to bet on the price rising. When the price drops past a certain point, the exchange automatically sells their position to cover the loan.
So the exchange doesn't lose money.
Right. And that automatic selling drives the price down further, which triggers more liquidations for other people. It's a cascade.
Classic flush.
It's a classic flush, a domino effect.
And it's not just the degen traders taking a hit. Michael Saylor's firm, Strategy, is sitting on roughly $9 billion in unrealized losses. $9 billion.
It's staggering.
I can't even wrap my head around a number that big.
But we have to ask, why now? Why this week? Sources are pointing to macro factors, but that's kind of a buzzword. We need to look at the mechanics. And the biggest mechanic flashing red right now is mining.
I saw this statistic in the research, and I had to double-check it because it just didn't seem real. The average cost to mine a single Bitcoin has risen above $87,000.
That is the number, and that is the problem.
Okay, hold on. Let's do the math here. If Bitcoin is trading at $64,000 and it cost $87,000 to create one, every new Bitcoin is a financial loss.
You got it. It's simple, brutal math. The difficulty of mining, the computational power required, is at an all-time high. At the same time, energy costs haven't come down. So miners are underwater. They are spending $1 to make, 70 cents?
So what do? They can't just print money.
They capitulate. They have bills to pay, electricity, hardware debt, all of it. Usually miners try to hold on to the Bitcoin they mine, waiting for higher prices. But when you are losing roughly $20,000 per coin, you don't have that luxury.
You have to sell.
You have to sell your inventory immediately just to keep the lights on.
So the people responsible for securing the network, the backbone of the industry, are actually the ones creating this massive selling pressure because they are desperate.
It's forced selling. They aren't selling because they want to. They are selling because they have to. And the market smells that desperation. Hedge funds know the miners have to sell, so they short the market, pushing it down even further.
Then you layer the geopolitical fear on top of that. The news cycle is heady right now. We have trade threats involving the U.S., Iran, Venezuela. Now, usually the pitch for Bitcoin is digital gold.
Yeah, the safe haven.
The bunker you hide in when the world gets scary.
And that narrative is currently failing the stress test. I mean,
Yeah.
look at actual gold. Physical gold has surged past $5,500 an ounce. It is doing exactly what a safe haven asset is supposed to do.
It's going up because people are scared.
Exactly. But Bitcoin is down 20% year to date,
The correlation is broken.
completely decoupled. Right now, Bitcoin is behaving like a risk asset, like a high-growth tech stock. It is reacting to fear, not hedging against it. Investors are scared, so they are dumping anything volatile.
And speaking of fear, we can't ignore the Fed. The nomination of Kevin Warsh as Fed chair seems to be spooking people. Why is he such a boogeyman for crypto?
Because he's a hawk.
Meaning he likes high interest rates.
Meaning he opposes the easy money policies. He is viewed as someone who opposes asset buying, quantitative easing. Crypto, historically, loves cheap money.
Right.
When liquidity is flowing, crypto booms. When the money printer is off, liquidity dries up. So you have a hostile monetary outlook, geopolitical fear, and miners dumping their inventory. It is the perfect storm.
And just to kick us while we are down, let's talk security. Because nothing says crypto winter like a massive embarrassing hack. Step Finance. What happened there?
This one is painful because it was so avoidable. Step Finance is a major dashboard on Solana. If you use Solana, you probably use Step to track your balances. On January 31st, roughly $40 million was drained from their treasury.
40 million. Now, usually when we hear about DeFi hacks, I assume it's some super complex code exploit. Did some genius hacker find a math error in the smart contract?
No, and that is what makes this so frustrating for the industry. This wasn't a code failure. This was a human failure.
Yeah.
The reports indicate compromised executive devices.
So someone clicked a bad link? Or got their password stolen?
Likely stolen private keys or an active session hijacking. It's the digital equivalent of building a bank vault with 3-foot-thick steel walls, and then the manager leaves the keys sticking out of the front door.
Right. It doesn't matter how thick the steel is if the guard just hands over the keys.
Exactly. That is the Wild West aspect that still scares off normal people. My mom isn't going to put money in a bank where the manager might click a phishing link and lose the deposits.
No way. And this is the biggest hack of 2026.
So far, yes. About 260,000 SOL tokens withdrawn.
I noticed you emphasized so far.
Well, we have to be realistic. If we look back at 2025, the industry lost $17 billion to theft. North Korea alone stole $2 billion of that.
Wow.
So in the grand scheme, $40 million is a drop in the bucket. But it highlights that operational security OPSEC is still the industry's Achilles heel.
Let's actually unpack that term OPSEC. We hear it all the time. Explain OPSEC to me like I'm 5.
OPSEC is just the process of protecting your information. In crypto, it mostly boils down to how you handle your private keys, the passwords to your money. It's about not keeping them on a computer connected to the internet. It's about using multi-signature wallets.
Where more than one person has to sign off.
Exactly, where 3 people have to agree to move money, not just one. It's, the hygiene of digital safety.
And Step Finance didn't have good hygiene.
Clearly not well enough. They did recover about $3.7 million, but the lesson stands. You can build the most futuristic protocol in the world, but if the human running the treasury has poor hygiene with their passwords, it's game over.
Okay, so the vibe is bad. Prices are crashing, miners are broke, hackers are stealing. I'm thinking about selling everything and buying a farm. But you mentioned a smart money anomaly.
Yes. This is where you have to put your emotions aside and just look at the data. If you look at the Bitcoin ETF numbers generally, it looks like a mass exodus. Fidelity, Grayscale, they are seeing hundreds of millions in outflows. People are cashing out.
Right.
But look at IBIT, the iShares Bitcoin Trust managed by BlackRock.
The big dog.
The biggest. While everyone else was bleeding, IBIT saw nearly $60 million in net inflows.
Wait, pause. While the market is tanking 11% in a single day, someone or a group of someones shoveled $60 million into BlackRock's Bitcoin fund.
Precisely. And this is what we call institutional consolidation.
Translate that for us.
It means the big players, the hedge funds, pension funds, the smart money, they're not panicking. They're predatory. They are looking at this price drop and saying, thank you for the discount. They are buying IBIT at the bottom of its trading range, around $35, $36 a share.
So while retail investors like me are looking at the chart and feeling nauseous, BlackRock's clients are looking at the chart and seeing an entry point.
Exactly. They are using the liquidity provided by the panic sellers to build their positions. It's a transfer of wealth from the weak hands, the leveraged traders and nervous retail investors who sell at a loss, to the strong hands.
The institutions with a 10-year time horizon.
That's it.
That is
Mm.
actually incredibly reassuring.
Or terrifying, depending on if you just sold at the bottom.
Right. And it's not just Bitcoin. This is the other part of the story that isn't getting headlines. Money isn't just leaving crypto to go to cash. It's rotating
Rotating where?
into the ecosystem. We saw net inflows into Ether ETFs, XRP ETFs, and Solana ETFs, even during this crash. That's surprising. Usually when Bitcoin sneezes, altcoins catch the plague and drop even harder. Why would they move money further out on the risk curve right now?
Diversification. They might be deleveraging from Bitcoin volatility, perhaps, but they aren't leaving the asset class. They're parking that capital in other protocols that might have different growth drivers. It tells me they are still bullish on the technology.
They just want to move their chips to different spots on the table.
Right.
Well, let's talk about those different spots, because while the price of these assets is struggling, the technology seems to be having a moment. Specifically, this collision between AI and blockchain.
This is, without a doubt, the most bullish sector right now. The market for AI and blockchain convergence is projected to hit, $1.88 billion by 2029?
I keep hearing about AI coins, but a lot of it feels like vaporware, just putting AI in the name to pump the price. What's real here?
There is a lot of vaporware, sure, but there are real protocols building infrastructure.
Yep.
Look at Bitensor, ticker TAO. It's up 140% recently, completely bucking the market trend.
What does Bitensor actually do? Is it just ChatGPT on the blockchain?
Not quite. Think of it as a decentralized marketplace for machine learning. Instead of one company like OpenAI controlling the model, Bitensor incentivizes a global network of computers to train AI models collaboratively.
So you get paid in crypto for contributing intelligence.
Or compute power to the network, yeah. It's democratizing the creation of AI. That actually makes sense as a use case.
It does.
And then you have Fetch.ai. They are breaking resistance levels while Bitcoin tanks. They use autonomous agents.
Agents, like bots.
Smart bots. Imagine a little piece of software that lives on the blockchain and can perform tasks for you, like booking a flight, optimizing a supply chain without you having to click anything. That is what Fetch is building. It's the automation layer.
Okay, and I saw one more in the notes. Virtuals Protocol.
Yes, they just hit a $1 billion market cap. They are merging AI with the metaverse, creating AI characters that you can own and interact with.
It sounds like sci-fi, but the money follows the tech.
And the venture capital proves it. A company called Mythic just raised $125 million for AI hardware. Mythical Games raised over $300 million. The smart money isn't just buying ETFs. They are funding the picks and shovels of the next era.
So the tech side is flush with cash. Which brings us to the grandfather of smart contracts, Ethereum. I feel like ETH gets beat up a lot lately on price, but are they actually shipping anything?
They are heads down shipping code. Ethereum has moved to a predictable biannual upgrade schedule, which corporations love because it offers stability. For 2026, we have 2 major upgrades on the docket.
I always love the names they give these things. What's on the menu?
First up, in the first half of the year, we have Glamsterdam.
Glamsterdam. Sounds like a terrible Eurovision entry or a very expensive nightclub.
It does, but it's vital. It focuses on gas efficiency and scalability. It's about making the network cheaper and faster to use, which is essential if we want those AI agents we talked about to actually run on Ethereum.
Right, without costing a fortune. And the second one?
Hagota, coming in the second half of the year. This is a bigger bundle of changes to the consensus layer. But the North Star for Ethereum in 2026, the big goal, is achieving 128-bit provable security by year-end.
Okay, that sounds impressive, like military-grade marketing speak.
Yeah.
But what does 128-bit provable security actually mean for the average person?
For you and me, not much. We won't notice a difference in our wallets, but for a bank or a government, it's everything. In cryptography, 128-bit security basically means it would take a supercomputer billions of years to crack the code.
So it's about future-proofing.
It's about liability. If a bank is going to move $1 trillion of tokenized bonds onto a blockchain, they need to know mathematically that it cannot be cracked. Ethereum is positioning itself to be that bulletproof settlement layer.
So let's recap. We have BlackRock buying the dip. We have AI protocols exploding. We have Ethereum becoming mathematically unbreakable. But we have to address the elephant in the room, the regulators.
Yes, the government. It's messy. It's a roller coaster right now.
Let's start with the bad news. I'm seeing a lot of hostility toward prediction markets.
Yes. This is a fascinating battleground. Nevada and Hawaii are leading the charge. Nevada actually issued a restraining order against Blockertize, the entity behind Polymarket.
Wow.
And Hawaii is introducing bills to explicitly define prediction markets as gambling.
Why the sudden crackdown? I mean, they were the breakout use case of last year.
Because they are powerful. They often predict outcomes better than polls or pundits. And governments get nervous when there is an unregulated source of truth that involves money. They want to fit it into the gambling box so they can tax and control it.
And then we have the Treasury. Secretary Scott Bessent came out and said something pretty blunt.
He stated point blank that the Treasury has no authority to stabilize crypto markets.
Meaning, if it goes to zero, don't call us for a bailout.
Correct. No Fed put, no backstop. You are on your own. That dashed a lot of hopes.
But it's not all doom and gloom on the regulatory front, right? I saw something about the SEC, actually, dismissing a case, which feels like finding a unicorn.
This was a genuine surprise. The SEC dismissed proceedings against a group called CryptoFed, but the reasoning was the key. They acknowledged that regulations have changed, specifically citing the Genius Act and new executive orders.
Wait, the SEC admitted the rules have changed?
Essentially, yes. For years, the complaint has been regulation by enforcement saying follow the rules, but never saying what the rules are. By citing the Genius Act, they are admitting that Congress has finally set some boundaries. It's a move toward clarity.
That feels like a sea change. And we are seeing movement in the Senate, too.
The Agriculture Committee advanced a market structure bill to give the CFTC more authority. Now, caveat here. It lacks bipartisan support, so it's an uphill battle. But the fact that legislation is moving at all is better than the stalemate we've had for years.
And what about our neighbors to the north? Canada seems to be handling this differently.
Canada's being very pragmatic. They introduced clear custody rules, differentiating between crypto assets like Bitcoin and tokenized traditional assets like digital stocks.
Why does that distinction matter?
Because they are different animals. Regulating Bitcoin like a stock doesn't work. Regulating a tokenized stock like a stock does work. That clarity gives institutional investors the confidence to enter the market.
So let's try to synthesize all of this. It's a complicated picture. We have a price crash, high mining costs, hackers draining wallets. But we also have BlackRock buying the dip, Ethereum upgrading, and AI protocols exploding.
It is a classic separation of price versus value. The market is in winter, the charts are ugly, the fear is real. But the technology is in spring, the infrastructure is being built, the smart money is positioning itself, and the regulatory framework, while chaotic, is slowly maturing.
So if you're looking at your screen today and seeing red, the advice is zoom out.
You have to follow the flows, not just the candles. Look at who is buying, not just who is selling.
Before we wrap up, you always have a final thought for us, something to chew on over the weekend.
Well, I keep thinking about those mining costs. $87,000 to mine a Bitcoin. That is unsustainable for a lot of players. But at the same time, look at the AI sector. It is absolutely desperate for compute power.
We are running out of chips. Everyone needs GPUs.
Right. Computing power is becoming the world's most valuable resource. So are we about to see the mining industry pivot? Instead of just burning electricity to secure a ledger, could we see massive Bitcoin mining farms retooling their hardware to power decentralized AI networks?
That is a fascinating pivot. If money isn't paying the bills, maybe intelligence will.
Exactly. From mining gold to mining brains, it's something to watch.
Well, on that note, keep your private key safe, turn on two-factor authentication, and maybe go for a walk this weekend instead of staring at the charts. Thanks for listening to The Deep Dive.
Stay curious.